Hello everyone. Well, the minutes from the March FOMC meeting gave a much more dovish impression of the Fed's thinking than the market's understanding. The key point was that there was no mention of the famous 6 months time frame that FOMC Chair Janet Yellen had previously said constituted the considerable time that rates would be held at current levels after the Fed finished its bond buying program. Moreover, several members expressed their concern that the market might misconstrue their projections for interest rates as indicating that they were moving to a less accommodative reaction function, which is precisely what did happen, in fact. As a result, Fed funds expectations fell 6.5 basis points, equities rallied, the yield curve steepened, and the dollar was sold aggressively. It's starting the European day lower against all of the G10 currencies and many emerging market currencies as well. Carry trades are back on, as investors now assume that U.S. rates will remain low for longer than they had previously anticipated, which relieves some of the pressure on emerging market countries and makes their relatively high interest rates all the more attractive. In the G10, the currencies with the highest carry are New Zealand dollar, Australian dollar, the Norwegian krone, and the Canadian dollar, in that order. Among emerging market currencies, they're the Turkish lira, Brazilian real, Indian rupee, the Russian ruble, the Indonesian rupiah, and the South African rand. These currencies could be the ones to see the most interest in the near future, although I expect the ruble to remain in trouble because of the Ukrainian situation. India and Indonesia also have elections that are likely to impact the currencies. Today, we've got a Bank of England policy meeting. Once again, that's likely to be another non-event, as all the economists surveyed expect the bank to keep its policy unchanged. Generally, there's only a momentary reaction in the FX market to these Bank of England meetings, if that. We have several CPI figures coming out Thursday that should reaffirm the idea that inflation in Europe is slowing. France's and Sweden's CPIs for March are both expected to slow. Norway, however, is different. Its inflation rate is estimated to remain unchanged, while the underlying rate of growth in CPI is forecast to have accelerated. That could support the Norwegian krone as one of the few European countries where the central bank is not confronting below-target inflation. In the U.S., the 4-week moving average for initial jobless claims is expected to remain stable, hence no market impact. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.